We have two buckets in our mind when we think of investing. There is the equity or growth bucket to build up our fortunes, and then there is the debt or fixed income bucket to provide us with some kind of safety from market volatility and some kind of possibly regular income. Now, the problem with the debt bucket that has come up in India is that the taxation of it is very unfavorable. So whether you do debt mutual funds or whether you invest in bonds and get interest from them, you are taxed at your slab rate, which at the highest level is 30% plus surcharge plus cess. Now, is there a solution to this problem? Because the tax takes a big bite out of your fixed income. That solution came up in the recent budget when the finance minister said that if you invest in funds that have less than 65% in debt, then you are under the 12.5% long-term capital gains tax after a 2-year holding period. So why is this interesting? Why is this important? Because now a host of hybrid funds have come out and more will come out, which are structured in a way that have up to 65% debt and they have some equity, which is typically hedged out partially or fully through derivatives, and they could have some gold or REITs in which. Essentially, these are in the multi-asset category, but they could also reside in other hybrid categories like the balanced advantage fund category. And why is this category a solution to the debt taxation problem? Because essentially you have funds that are very, very debt-like, very similar to debt with a little bit of equity, but with a taxation that can massively improve your yield, your post-tax yield. So let's take an example. If you invest in a debt mutual fund which has a 7% pre-tax yield and you apply your 30% highest slab rate, then you end up with roughly a 5% post-tax yield. The tax man has taken a 2% bite out of your investment. If you get the same yield in a hybrid fund, which is 7%, and you apply the 0.12, the 12.5% tax rate, then your post-tax yield improves to 6%. And the 1% difference, if you think of a multi-year time period, really compounds. So I think that going forward, you should really consider hybrid or multi-asset funds for the debt part of your portfolio. Yes, there's a little bit of equity in it. Yes, there's a little bit of risk in it, but this is largely contained. It's a small part of the portfolio. It's a trade-off that I think is worth making.